So what I was doing as an introduction is to say that we're going to go to revisit markets, but now with more economic tools to get into the externalities in general, and in particular the issues of pollution, which in fact many of you wrote in your essays, and I will have some comments about your essays in a second. But the idea is to use this unit 12 in the textbook to go back to the discussion about efficiency, public policy, and have a critical view of how a market economy deals or fails to deal with the problems of externalities. And for that, the plan that we will be covering is the following. After I do some annotations on the essays that I want to get at, I want to go back where we left last week about this World Bank memo that leaked about the proposal to relocate dirty industries to less developed countries. And I want to get back to that in terms of a few discussions on how that relates to the analysis of markets. We are going to go back to the cars market that we did in the first part of the course, and then introduce this idea of externalities in the sense that when we do not account for the consequences of our actions, and yet those actions harm other people, we are within the domain of externalities or external costs, and we need to address that somehow with policies, with tools that are available, and they may involve certain strategies to correct these so-called market failures. They could be corrected through command and control measures that restrict the actions of the players, or limit the possibilities of doing these actions that harm other people. But we can also use other kind of economic instruments that may have to do with subsidies, taxes, marketable permits, and the like. So in this first part of these 2 weeks, during this particular week, we are going to be addressing this issue of externalities, and I'm going to be using an example that it's presented in the textbook that I think it's pretty pedagogic in explaining when you have, in this case, two particular players, some people that are growing bananas and they are using certain pesticide, and with the use of that pesticide, they increase their profits, but the use of that pesticide is harming fishermen who are in a lake downstream. How do we understand that problem from an economic perspective? How we analyze the different costs and benefits associated to that interdependence, to continue with the game theory jargon. And with that in mind, how should they deal with this issue? The banana growers want to continue their business of growing bananas, and the fishermen want to continue their business of extracting fish out of the lake. But the actions of the former is going to harm the economic opportunities of the latter, and we need to address that. And then on Thursday, we will deal more specifically on the different instruments that we may have available to us in terms of different mechanisms, as I said, using economic incentives or using command and control type of measures. So that's the plan. Let me start quickly with a couple questions that I wanted to do here in terms of the reading of the World Bank memo and the reading of the first part of this chapter 12, just to get an idea of how far you are into those. Okay, so I have almost 3/4 of you, and you're getting close to complete the answers. And okay, so let me stop there. And since I am seeing here exactly a tie between those who read the World Bank memo and those who didn't, we are going to have to update the other half in that very quickly. And in terms of the reading of chapter 12, I see that most of you, at least 2/3 of you, have read up until section 12.4 and further. So that's good to hear. Okay, so let me then get to the memo immediately. So this, as I mentioned in class last Thursday, this memo was written in 1991. And so this coming December, this is going to be the 30-year anniversary of this event. And this was a controversial event in many ways, because the author of the memo was Larry Summers, which you have probably heard in the news because he has been very vocal in debating the risks of the plan, the Biden plan, for pumping the economy with this $1.8 trillion into the economy, the risks of that, whether that's too much or too little. And Summers is a very famous and very smart economist at Harvard. And you may remember he was president of the University of Harvard University. And then he was asked, or he resigned due to some controversy regarding gender issues. He was presenting some particularly controversial positions with respect to the participation of women in science. And that created yet one more huge controversy that eventually led to his resigning to the presidency of the university. He's still a faculty and a very active one in public policy and the like. And as I said, a very smart economist. He has written very influential papers. He has been contributing to the literature a lot. And he is very controversial in his positions. And he wrote this memo with the idea of proposing that dirty industries should be shifted to developing countries, to LDCs, less developed countries. And he argued several points that I'm going to detail in the next screen of why that could be an interesting idea to consider. In the notes for last week, I included, and as I put in my message over the weekend for you to read, an explanation of this. He tried to communicate, I don't know how effectively in the public, that he would never dare to suggest this as an actual public policy. To me, the question is, if so, why indeed he wrote this as a discussion. He argued that he wanted to create an intelligent discussion among his technical team of what is on the table when dealing with the problems of pollution, the problems of environmental degradation, but at the same time, the problems of the gap or the bridge between less developed countries and more developed countries. And let me go to the points, because then this would be an important issue. And maybe I will first explain and then do a poll, because if you haven't read this, it wouldn't make any sense to show you the following, the contents that I had already sent. But here are some 5 bullets of what I think are the key issues in his position. he starts with the proposal that whether the World Bank should encourage to migrate more dirty or dirtier industries to the less developed countries. And he argued this on three reasons. One, given that, and I am highlighting in red the key points, given that the amount of health impairing pollution, the amount of harm created to the health of individuals should be done in the country where that should have the lowest cost. And in that case, it should be the country with the lowest wages, which corresponds precisely to less developed countries. It would be a reasonable economic idea to transfer these dirty industries to places where people earn less. Because if they're going to be harmed, the income that is lost due to the environmental harm to the health, it's lower. And the reasoning for this is simple. When people estimate economic losses from health losses, it is based on the opportunity cost of time, which is based on the earnings and therefore the wages that people earns. So if you have two people and one of them earns $1 million a year and the other one earns $100,000 a year, 1 day of work lost for these two people who were harmed by an environmental impact that affected their health and they couldn't work for that 1 day. Well, according to the economic estimation, the first person who earns $1 million a year will generate a loss of income that is 10 times the loss of a person who earns $100,000 a year. So it's a 10-to-1 economic loss, basically because these two human beings earn different wages due to their jobs. So that's the first point, point one. The point two there is that these costs of pollution, as he says, are likely to be non-linear. And by that, he meant that the countries that are vastly underpolluted, that's his wording, this is the literal text, the countries that are vastly underpolluted, they could put up with much pollution from the economic activities of these 30 industries because those places are not saturated with the externalities, with the harm, let's say in terms of polluting the air or polluting the water. And therefore, these places that are underpolluted will suffer much less because of the pollution, as opposed to other places that are overpolluted. And I am going to share with you later precisely a major controversy that happened exactly on this account in a town in Italy whose economy depended entirely on this huge polluting, I remember, if I remember correctly, metal industry. I don't remember if it was iron or some kind of heavy industry. And the entire town depended on the pollution, no, depended on the economic activity of that industry, but at the same time, the harm from the pollution of that industry was huge. And there was a big debate that came all the way to a vote in the villa, in the town, on whether they would favor or not that the industry remained in the town, because that industry provided the jobs, but also provided the pollution for most of the people. And that's an interesting case of exactly what we're talking. So that's number two. And then number three adds up to the previous 2 points that he argues there is a greater demand for clean environment and for aesthetic and health issues in high income countries. In the sense, the text argues, that people in richer countries have more demand for a clean environment, for clean air, for valuing their health, because they are a more advanced economy, if you want to put it in those words, and therefore moving those industries to places where there is less demand for a clean environment and less demand for these health issues. And he mentions even there cases where the mortality, the child mortality is so high that these people are not going to even live longer to suffer the long-term consequences, let's say in terms of prostate cancer. This is, again, his words. And in fact, by coincidence, we'll be talking about prostate cancer. That would be yet one more reason to justify that these dairy industries move to less developed countries. So there you have it. And these are arguments, economic arguments, of why it would make sense to transfer these dairy industries to those less developed countries, and the economic arguments that I just laid out there. So before I ask you your reaction about this and how we could discuss this within the terms of our course, which is exactly about the political economy of the environment, let me ask you two questions that are more like comprehension of concepts that we have already discussed in the course regarding Pareto criterion and efficiency. And so let me ask these two questions to you guys. So here's the idea. I want you to don't answer the questions yet. Don't answer them. Let me again relaunch here. Don't answer them. What I'm trying to say is the following. Think about these two questions. Think what you answered already, and discuss with your other partner what was your reasoning for answering those, and then we'll come back and answer again and see what happened there. And the reason for that is the following. Regardless of whether you agree or not with the proposal, or you think it's politically problematic, if you think ethically is problematic in terms of moral reasons, independently of that, there is an economic reasoning that I want you to be very clear with why that was the position of defending this proposal, okay? So let me do that with the breakout rooms quickly. So the way I'm going to do it is that it's 24 of you, so I can perfectly create 12 pairs, and I'm going to send you, and we'll be back in 3 minutes. I just want you to discuss these two questions and just share with the other one what you answer, hear each other about your reasoning, and then come back. Is that clear? Okay? Okay, so let's do that, and let's assign 12 breakout rooms. It's just in pairs, so go ahead. So now you should be able to go. I see you going, good. And let's see. Okay, good.
But he didn't post the grades for the paper yet, right? Oh.
Okay, hi. So you guys are back. Great. So before I hear you, I want you to again answer the poll. There it is. And I have 3 people left. 2. We're almost there. Okay. And now. So now we have, now let me capture this in the screen again. So that I don't lose this. Okay, so this is the first time and this is the second time. Let me put it here. Oops. Okay. And what I see here, let me share these results with you. Here they are. And let me see if I can put this. So this is 68%. Let me see if I can put this larger here. No. And here. Okay, and here. So they are not that different. And so let me go first to the, let me go to the first question and then the second one. Anyone wants to defend the first response, the true response? Anyone wants to argue why this is supported on the idea of operator improvement?
I can say I support.
Yeah, go
I
ahead.
think it's true. Because like the wealthier countries are like willing to lose that that industry, that income in exchange for the air quality. They see that as like an improvement, while the poorer countries, like in his reasoning, with their extremely low levels of pollution, they'd be willing to like increase that in exchange. They would value the jobs and the income more than the level of pollution increasing. So that's what I believe. It's an improvement for both parties.
Okay, so in that case, you are arguing that the exchange for losing the industry for improving air quality, let's say, it's a net improvement for the rich countries, and at the same time, it's a net improvement for the poorer countries, because the poorer countries are getting the benefits of those industries, right? Regardless of the harm or the economic losses from the environmental pollution from those industries.
Yeah.
Right. So in that sense, that's why Joseph thinks that the answer should be true. Now, I want to hear from those, there are 7 of you who claim that this is false. Anyone of you guys who claim this is false want to reason about that in contrast to what Joseph just said? Anyone of you guys who said false? It's just that I don't know who said false. I mean, I will know eventually, but I need to download the data from Zoom. But anyone who said false in that question or would want to comment on Joseph's arguments?
I can go. So I clicked on false because a Pareto improvement means you have to improve both people, or at least one person, without harming anyone.
Yep.
So because you're making a dirty industry, you're harming the people that lives nearby, right? So someone's being harmed.
Right.
So it shouldn't be a Pareto improvement.
Thanks for that, Jonathan, because this is key here. This is going to be key for the rest of our course. Because notice, in a way, both Joseph and Jonathan have good reasons to defend their answers. But this is why I wanted you to confront this question and answer. And the reason is the following. Joseph's arguments are based on the net benefits and costs, in the sense that if you think of the richer countries, they are going to have a loss of benefits from seeing those industries leave their country, the richer countries, and that's going to add up in terms of costs. But they are going to see an increase in benefits from the better environmental quality. So netting those out might be beneficial within the reasoning that Joseph described. Meaning those richer countries see industries go, but the increase in benefits from the improvement in environmental quality are going to not only cover those costs, but leave a net benefit to society in those rich countries. And based on the arguments of the memo, if you remember, it included the fact that in those countries they have higher wages, higher life expectancy, and just by having higher wages and higher life expectancy, the economic value of the quality of life enjoyed for longer terms and greater appreciation of health and so on and so forth, according to that reasoning, is going to be worth much more than the losses from losing those industries. That's from the standpoint of the rich countries. Likewise, in the poor countries, people live less, they appreciate less the environment, and they are going to be underpolluted. And for all those reasons, according to the memo, again, his words, not mine, the losses from the environmental damages from bringing in those industries are going to be smaller. And at the same time, the benefits from bringing in these industries and creating jobs are going to be large, and netting those out is going to be also a net improvement for the poor countries. That's Joseph's argument, and it's reasonable, it makes sense. But notice, Jonathan's arguments make sense too in the following way, because there is a harm inflicted on the poor countries by transporting those industries to there, and those people are going to lose, whereas the rich countries are going to win because they are seeing those polluting industries leave. The bottom line here is, which are the indicators that you are adding up when you are evaluating with the Pareto criteria whether an improvement in at least one player without harming the other player is going to be present to declare this a Pareto improvement. So again, Jonathan and Joseph might be right both. It depends on the metrics that you are using for what are you evaluating. From Jonathan's point of view, he's looking at the environmental harm, so therefore it shouldn't be a Pareto improvement if you are considering only the environmental changes for both the rich countries and the poor countries, because the rich countries are improving their environmental level, but the poor countries are lowering their environmental level, and therefore they are losing, and therefore it wouldn't be a Pareto improvement. So again, in summary, it needs to go down to deciding which is the metric. And later on that we advance in the course, we will be talking about valuing environmental benefits and environmental costs so that we can do a good accounting of how to measure all these things together. And therefore, later on in the course, we should be able to come up with a way of reconciling Jonathan's answer and Joseph's answers. And as I am saying, they might be both right depending on the metric that you're using, okay? So that's for the first question. For the second question, it's related to the first, but notice here, and you see in the answers, and the first time I asked, they were a little bit less false answers and a little bit more true answers. That's interesting, but they are balanced somewhere about half and half. The idea that both countries, rich and poor, would win from this migration, it's quite controversial. Because again, it could come down to the problem of which metric are we using to evaluate that both types of countries win or not, right? If we are talking about only environmental quality, it would be false. But if we are talking about jobs, it would be false too, because jobs would be lost in the rich countries as these industries leave the rich countries, but jobs will be generated, will be gained in the poorer countries. But if you add up everything that comes in terms of health, jobs, income, wages, life expectancy, and so on and so forth, it might be the case that this is true, that both could win under that argument. Meaning, again, using the economic arguments of the memo, meaning that people in the poor countries earn lower wages, they have lower life expectancies, and those countries are underpolluted, and therefore the economic losses from the environmental degradation are so small that they justify bringing in all the other economic benefits of bringing those industries and generating wages, profits, earnings, and the like. And that's part of the economic reasoning. Now, let's leave there for a second this economic reasoning in those terms. And now let's expand the issues of justice and the issues of fairness. So suppose that such policy could be implemented, right? In the sense that somehow you get a World Bank loan to do this transfer, to shut down these dirty industries in the rich countries and set up these dirty industries in the poor countries. And with that loan, the World Bank does its cost benefit analysis and it finds that it's worthwhile implementing this because these poorer countries are going to generate extra revenues, taxes, wages, etc., and they will be able to pay back the loan to the World Bank, and the project will pay for itself. Would you find that fair? And when I say that, and let me go back to the following screen and the following slide that we had at the end last week, this is how we should be evaluating institutions and allocations in economic terms, with a broader perspective and not just the costs and benefits of this kind of measures. So if I go to the first part of this diagram on the allocation of who does what and who gets what, we have pretty clear here that the richer countries get rid of the dirty industries, the poorer countries acquire these dirty industries, and eventually you generate more jobs, you generate more profits for the investors in the poor countries. And so that's for the first part, which is the allocation. Is the allocation efficient is one question, and is the allocation fair a second question. And in terms of the first question on whether is the allocation efficient, in which it says, could there be mutual gains from moving to some other allocation? There could be mutual gains if the reasoning of that memo is correct. Namely, that the mutual gains will come, as Joseph argued before, that the rich countries will see a net increase in their well-being because of the improvement in health, and the poor countries will see a net increase in their well-being because of all the economic gains despite the environmental costs. So let's suppose for a second that even the allocation is efficient. Again, that this is a net win-win situation. Then comes, even if that's true, then comes the second question. If this allocation is fair. And I want to ask you, what do you think about that allocation in terms of fairness? And even further, as you can read in the screen, is there another allocation that could be fairer than that one? Was the rules of the game that produced the allocation fair? In this case, again, I put it as the World Bank offered a loan and the poor country got the loan, and with that loan implemented the whole thing so that the poor country could generate these jobs, generate those profits, generate those tax revenues, and generate some dynamic into the economy. So I want to hear from you, what do you think about the fairness of that allocation? What do you think about that? Anyone? Should I pick one of you in terms of that question? Let's say Brendan. Brendan, do you want to say something about that second question?
I'm not really too sure, Professor.
So what do you think? Do you think this is fair or is not fair?
I'm not really sure.
Okay. Let's see. John, are you there?
Yeah, hi.
Go ahead.
For was it the second question on whether?
Yeah, whether this allocation is fair.
I said no because the poor country isn't necessarily going to benefit when they're dealing with the pollution.
But in terms of jobs and tax revenues and progress, what do you think?
That would be an advantage, but I think it's kind of harder to measure whether those are directly counting against the negative effects of pollution.
Right. And I agree with you. I mean, John's point is important here, because how can we compare apples to apples and oranges to oranges? And again, we will be dealing with that later on between today and Thursday and later in the course. But the fact that it is difficult to be sure what kinds of benefits came from these newly arrived dirty industries and how much of the environmental damages are a consequence of those industries is going to be a big part of the problem. So in John's words, this is not fair from his point of view, because anyway, these countries are going to be suffering a lot from the pollution, and there would be moral reasons, ethical reasons to think that that would create a situation that is unfair. Any other argument? Anyone else wants to put on the table arguments on whether this is a fair or an unfair situation? Anyone else?
Yeah, I think given that the benefits of the jobs outweigh the negative effects of the pollution, if both parties are benefiting, I mean, sure, like the countries getting the dirty industries would probably be a little bit, they'd ask like, okay, we're just getting this because you don't want it. But like, that's kind of how it works. So if both parties are benefiting, like I do think you have to call it fair.
Okay. Now, Thomas, I think that's interesting. And when you say both parties, one can think of, let's say, the presidents of the two countries, right? So the presidents of the two countries sit down somewhere and they sign up this agreement and they get the World Bank to facilitate this, and the World Bank is going to finance the whole operation. But here comes one extra detail in terms of who is each president representing. So let's suppose that that president from the rich country is representing the interest of the general population of the country, but this particular industry is in this particular town. And those people in that particular town in the rich country, which is like the Italy case that I'm going to show with you, those people are going to lose their jobs, but net for the entire rich country is going to be a gain because they're going to get rid of all this pollution and they're going to value the improvement in terms of health and aesthetics and the like. Again, in the poor country, the president is going to represent who? The entire country, but that means also representing the people who get the jobs, who might not even live in the place where the toxic waste is dumped. So you could have within each country winners and losers arguing on whether they deserve to get what they are getting, because the president is thinking of the country as a whole, but within that you are going to have the jobs lost in the particular town in each country and the jobs gained in that particular place where the industry is located, but also who is going to get the harms and who is going to get the benefits from those transitions, because these presidents are representing the entire countries. So that gets into a more complicated level of analysis, and the political economy within each country is going to be important. So who is going to lobby within each country against or in favor for this to happen? So imagine Congress stopping the president or pushing the president to go ahead with that agreement. That is going to be a key into all that discussion. Crystal, you raised your hand, go ahead.
My internet's spotty, so I'm sorry if I break up, but I was gonna say that the institutions or the rules of the game aren't fair because there are other like externalities to the pollution that aren't being considered, such as like the effects of the pollution on like future people in the area, or like even the land itself, like all that stuff. Like the pollution could in the future cause the land to not be able to produce enough food, like that kind of thing. All of those are not considered as part of the institution, so the institution itself isn't fair.
Right. No, I completely agree with you, Crystal, and you are adding one more component here. So in both cases, the country that is getting rid of its dirty industries is going to see, let's say, the recovery of those watersheds, the recovery of those soils, of those lands, and future generations are going to benefit from that. And as Crystal is saying, those new generations are not here present on the table. They are not negotiating on the table because they don't exist yet. Even more and more complicated is the case for the poor country, with the dirty industries now harming not only the present situation, but also harming the possibilities that future generations enjoy a cleaner environment. And those people are not present in the negotiation. And in that case, Crystal is bringing one more dimension of fairness, which is intergenerational fairness, not only within this generation, but also between generations. And that's key for sustainability, because in the sustainable development debate, we have the problem of those further down in time that are not present, but definitely are being harmed by the actions of the present generation. So that point that Crystal is making is going to add to the complexity of what we're trying to deal here. So that let's leave that here as a situation that it's, at least it may seem, fortunately hypothetical, because it was never implemented or proposed as an actual policy. But it's useful for what I'm trying to show in the screen, which is what we need to ask ourselves in terms of different institutions and allocations that will generate consequences for different players in the game. And if you think about your papers, which I'm going to mention a few things at the end of class today, if you think about them, there's going to be many of these considerations present in many of your analysis that you're doing. So if you think within the game that you are analyzing in that essay that you sent me, there are these issues that are present in the screen, quite present there. They are there on whether the different situations are efficient, they are Pareto optimal or not, but also if they are fair and to whom, or if they are unfair and to whom, in the sense of when you allocate rights, when you allocate possibilities of action, when you allocate results, so that you decide who does what and who gets what, that needs to be subject to the evaluation through efficiency, but also through the lens of fairness, for us to be more comprehensive to what is happening with respect to any political measure, economic instrument, public policy that is going to be implemented. And with that, let me now go back to our experiment in the first class on the market for cars, because I think this can take us back to one more case in which we need to evaluate both the issue of fairness and the issue of efficiency. So let's recall a little bit of these numbers. That particular experiment was inspired precisely on the fact that we have a real market today for cars, and the market for cars today has important numbers in terms of jobs, in terms of units traded, in terms of investors' earnings, in terms of also the consequences of that production and consumption of those cars. So these raw numbers that I showed you when we were doing this at the beginning of class give you an idea of the dimension of this particular market. And in our classroom experiment, when we run that, you may remember these numbers. Indeed, the market converged towards equilibrium. And in that equilibrium where supply and demand meet, we are supposed to be socially efficient in the absence of externalities. So going back to the transactions in the blue dots, those converge pretty much in average towards the market equilibrium, namely that number of units and at that particular average price, which is, by the way, Pareto efficient. So economists have proved this theoretically, mathematically, and also empirically, that if you have a well-running market that is competitive and you have enough suppliers and demanders or people who are interested in purchasing these goods, if you allow the market to run freely, you will produce a situation that is Pareto efficient, in the sense that you could, at the market price, the equilibrium price, you would not be able to reallocate the transactions so that you improve someone without harming someone else. Okay, so that's in general part of the theorems of economic welfare that have been proved. Ken Arrow, a famous economist, was able to put all this together and prove it. The problem is that in the red dots, we have the same market, but that market included economic externalities. Namely, if you remember that if we were accounting for the costs to each of you of adapting and mitigating to climate change, those gray bars accounted for quite an amount of money in those 3 rounds. If you compare to rounds 1, 2, and 3, where those costs of mitigation and adaptation were not considered. So if you think of the yellow bars as the economic gains from the market, which they are, because they are the net earnings of you guys because of the freely conducted transactions that you had during the experiment, which is good. The yellow bars are good because this was wealth created. This was well-being created out of the market. In the last 3 rounds, if you net out the costs from the externalities, the adaptation and mitigation because of climate change, then the net sum of the yellow bars minus the green bar, the gray bars, is going to show you that this is not such a good deal. Now, I decided to assign a particular cost per car, per round, per person. But then that number could be higher. That number could be higher for a whole number of reasons. So imagine that a certain country, the accumulation of pollution is so much higher that now that cost per person, per unit, per period is much higher because there is already pollution accumulated in the atmosphere, as opposed to brand new pollution without accumulation of such emissions in the atmosphere. So all those things are getting together, and I want you to begin to connecting the dots of what we have been doing. And the point is the following: those gray bars were suffered by all of you, regardless of whether you traded 1 or 2 or 3 cars or no cars. So imagine that you are one of those countries that decided not to have a car industry, and you're not selling cars, you're not producing cars. Further, imagine that you in that country, not only you don't produce cars, but you decided to get rid of cars because you set up in your country a system of public transportation, bicycle use, electric transportation, and you don't want cars and you forbid cars from production and from consumption. Yet you had to pay out of your pocket those gray bars component. Because anyway, in your country, imagine a small island in the Polynesian Islands or in the Caribbean that decided to get rid of cars, both from production and consumption, yet those islands had to adapt and mitigate the problems of climate change because of floodings, hurricanes, tornadoes, the increase of the sea level. And that's part of why we need to ask ourselves again, is that efficient? That's one question. Secondly, is that fair? And with that in mind, is that sustainable? And remember Crystal's words. In those places, those people are not represented today on the table when bargaining over what to do. Because those people are not born yet. Unless, of course, we decide that we are going to represent them with our own presence if we are altruistic towards our kin, our descendants, and still we are going to be privileging the rights that we have today over the rights of those people who are not born yet. So once again, for the case of the market that we had that first day of class, if we think of this framework for evaluating that market as it was in the second 3 rounds, we need to ask ourselves, is this allocation efficient and is this allocation fair? And notice in this case, and in particular for the case of efficiency of the allocation here, it could not even be efficient because the costs of mitigation and adaptation could be even larger than the actual gains from the market. And that will depend on how much does it cost to do one or the other one. By that, I mean, how much does it cost to stop the economic activity and lose the wins or the earnings from that economic activity against eliminating the harms, the costs from the environmental degradation from that activity. And for that is that we're going to be working with this model of the banana producer that I'm going to introduce today. But that with the car market and what we did in the first section of the course about how the market economy worked out, I want you to remember these 3 key points that were crucial to understand why the capitalistic revolution took off and why it has been so successful. The assignment of property rights. So in the case of the cars, the assignment of property rights to the raw materials, the cars produced, and the people purchasing the cars. The assignment of private property towards the equipment, the capital goods that are needed to make all this work out. The property rights over the money, the cash that buyers have to purchase the goods. So that's one key component. Second key component, that we have the market for people to meet with each other and connect and trade. That's a key second component. So that you can connect buyers and sellers through the market, so that people who want here in Colombia a car that was manufactured in the US, they meet somehow somewhere in the market. And this Colombian person has the cash to buy that car produced in the US and sends the money and gets the car back is key here as that second point. And third, the idea that we have firms that own, possess, because of property rights, possess the capacity to retain all the gains, all the revenues from its own production and the selling of those goods, and is capable of hiring workers to work for a wage and be able to produce that. And that works fine with cars. But it doesn't work as fine when we think about the other component of the market, namely the CO2 emissions. So all this economic activity of producing and buying cars produces CO2 that goes to the atmosphere. And here we have the first problem with private property, because nobody owns that CO2. In fact, nobody wants to own that CO2. And that creates a challenge for using that framework of understanding the market economy to be able to address these problems. Secondly, there are no clear markets to trade the property rights over these damages. And this is why some environmental economists are today trying to build markets for permits for pollution, in the sense that you put a cap on the total number of tons of emissions, and then people trade the right to increase or decrease their own pollution with other people, so that people that are efficient in producing cars without emissions they sell the rights to other people who own their industries who do not have the technology to reduce their emissions. And those are attempts to partially solve this problem of creating markets. But even with that, notice there are no markets that make it clear who can trade with who the right over a clean environment. That doesn't exist. Because in fact, because of the first point, we don't have a private property over a clean environment. I have a private property right over the car that I purchased. I used to have a private property right over my cash with which I bought that car, and I transferred the private property of that cash towards the seller, and the seller transferred her property rights over the car to me. That doesn't happen because there are no markets for doing that with, let's say, CO2 emissions, if we want to talk about that example. And thirdly, also along those same lines, there are no firms interested in producing or reducing CO2 emissions. At least for now, this is not a good business yet, because you cannot assign those private property rights over that clean air or that clean atmosphere, right? So right now we are in a puzzle, because all those ideas in the left that you see there in the left in the screen that used to explain the success of the market economy are not going to work to make the market economy solve the problem of environmental degradation. And for that, we are going to be discussing on Thursday in detail this model of these particular banana producers and the fisherman in the lake. And let me just introduce you this with actual data, because this is based on a true story. Unfortunately, is a true story. And the true story has to do with precisely these two islands in the Caribbean that used to be French colonies, Guadeloupe and Martinique, that for many years used this pesticide called chlordecone or Kepone. And it was used to stop pests that were attacking banana trees in the banana plantations. And this is true story again. These are the facts. And I'm going to give you a link below there that you can check if you want. In 1976, the French government forbid the use of this pesticide. But only in 1990, it was forbidden in those two islands. Several years later. And in fact, the banana growers were able to lobby to postpone the ban until 1993 because of the costs that would accrue if they were to stop using that pesticide in their plantations. Between 1972 and 1993, 300 tons of this pesticide were applied in those fields, 300 tons. And in 2012, Martinique had the highest rate of prostate cancer in the world. This is documented because of the use of that pesticide. And this is how it connects to the idea of prostate cancer that the World Bank memo described. So I am going to give you with that and quickly a few mentions about the essays, but I wanted to get you connected to this problem and go through the reading in the textbook, because we're going to be using that particular model on Thursday to discuss how we model this in economics. So about the essays, couple annotations that I wanted to do. So let me get my notes back, but I wanted to mention a couple things. I am not finished with evaluating all of the essays yet. Some of you are already seeing my comments in the Turnitin application in Moodle. But I am seeing a couple things that I am missing in several of the cases. A few of you didn't use the matrix to build an actual matrix with numbers. so that you could make the analysis. And therefore, the analysis that you are making in the essay, if it is not supported on an actual matrix, it's harder to get at whether you are correct or not in your analysis. So I am missing those matrices and those payoff matrices in some of the cases, and you are seeing that in my comments. So I wanted to let you know that, because that's the way we get concrete into the analysis. And the second one is, some of you are trying to maintain the perspective of the society as a whole, but you need to analyze the perspective of each of the players' standpoint. And in some cases, I'm missing that you're not seeing from the standpoint of each player. And that's why we use best response dominant strategy, as opposed to the social optimum of the whole game that is for the whole society. But these are two things that I wanted to mention, because I'm seeing this in several of the papers, and that you were missing these two things that I think are crucial for the exercise. So I wanted to let you know that. I am trying to finish that up, hopefully today. I had a rough weekend here, but I will try to get those back to you as soon as possible. So that's it, and thank you. Sorry that I stole a couple of minutes of your time, and see you guys on Thursday. Okay?
Thank
Professor,
you.
sorry, I have one
Thank you.
question.
Thank you.
Bye-bye.
Professor, sorry, I have one question. Do we have a